Imagine two guys. Jake buys a rental property, and Marcus puts the exact same amount of money into index funds. Fast forward a bit, they check their accounts, and boom, they both think they made the absolute smartest financial move. But here's the crazy part. They're actually both wrong. See, one of them completely forgot to count the hours, and the other guy forgot to count the zeros. And when you sit down and run the real math over 20 years, mapping out the actual hidden costs, the final gap between them is going to make your stomach drop.
So to keep this totally fair, let's say Jake and Marcus are the exact same age, living in the same city with the exact same financial starting line. They both have exactly 50 grand saved up. The only difference is what they actually do with that 50 grand. Jake takes his money and uses it as a 20% down payment on a $250,000 rental property. He locks in a 30-year mortgage at 7%, which leaves him with a monthly payment of about $1,330. Now Marcus takes his $50,000 and drops it straight into a total stock market index fund. He sets up an automatic contribution of $300 a month and literally just walks away. No tenants, no banks, no house keys.
Now here's why this matters right from day one. On paper, Jake feels like an absolute financial genius, right? I mean, he's got a tangible house he can actually drive by and point at. He's got this great story to tell his friends at dinner parties. Meanwhile, Marcus just has a boring confirmation email. But, feelings and math are two very different things. And while Jake totally feels like he's winning, the reality is they are both fundamentally misunderstanding the long-term math of where they put their money.
The landlord illusion. For those first few years, Jake is absolutely living the dream. Rent checks hit his bank account on the first of every single month. He's claiming depreciation on his taxes, and he is building equity. To him, and to pretty much everyone he knows, this investment feels incredibly real and exceptionally smart.
And if you look at the math that basically every real estate influencer on the internet talks about, it makes total sense. Jake finds a tenant who's willing to pay $1,800 a month. He pulls out a napkin, scribbles down his $1,800 rent, subtracts his $1,330 mortgage, and boom, he calculates a super clean $470 a month in profit. That's almost $500 a month in purely passive income. Except, well, as you're about to see, it is anything but passive. Because here is the detail most people completely miss. Let's look at the actual hard numbers through year 3. Jake has collected a gross cash flow of $16,920, which sounds incredible, but hold on a second. Property taxes? Those cost him $3,000 a year. Insurance is another $1,500 annually. Oh, and he had to replace a busted water heater for $1,200 and patch a leaking roof for another $2,800. Plus, he had one single month of vacancy between tenants. That 1 month cost him $1,800 in lost rent, not to mention the cleaning and relisting fees. So when you actually subtract all those real-world, unavoidable expenses, that $16,900 gross profit just evaporates. His actual net cash flow over 3 whole years? It's somewhere around $2,000 to $4,000 total.
And get this, that tiny net profit doesn't account for a single hour of his actual time. Meanwhile, you want to know Marcus's number? 0. 0 is the exact amount of hours Marcus spent managing his portfolio. No 10 p.m. phone calls about a clogged toilet, no giving up his weekends for house showings, no coordinating emergency repairs on his lunch break. And despite literally doing nothing, his $50,000 plus those little $300 monthly contributions has quietly grown to about 76 grand.
But honestly, the bigger story here is why Jake is still building wealth despite that absolutely terrible cash flow. It all comes down to the 5-to-1 power of leverage. See, Jake only used $50,000 of his own money to control a massive $250,000 asset. So as that property appreciated by just a normal 3 to 4% a year, his equity, which is just the difference between what the house is worth and what he owes the bank, has grown to up to $65,000. He is literally making money using the bank's money. And honestly, this is the one major superpower that stock investors just cannot easily replicate.
All right, so if real estate has the sheer magic of leverage, how on earth does the stock market keep up? Let's talk about the compounding curve and the crazy power of just waiting. Let's shift our focus back to Marcus and see how the painfully boring math of index funds eventually transforms into something spectacular.
Underneath the surface, Marcus's wealth is growing in a curve. Now, for the first few years, this compounding is honestly incredibly boring. By year 2, his account is sitting at maybe $61,000. It really doesn't feel like much is happening. But by year 5, that curve starts bending upwards to $135,000. And by year 10, his portfolio pushes past $165,000.
What's happening here is the snowball effect. The gains on his gains are actually starting to generate more brand new wealth every single year than his original out-of-pocket contributions.
And this brilliantly illustrates the real power of waiting. Listen to this. Out of his roughly $165,000 to $180,000 portfolio at year 10, Marcus only put in $86,000 total. That's just his initial $50K plus his monthly inputs. The massive remaining balance? That is pure, 100% hands-off compound growth. So at the 10-year mark, we hit this really fascinating milestone. They are surprisingly close in total wealth. Jake's home equity is sitting somewhere between $170,000 and $184,000, and Marcus's stock portfolio is hovering between $165,000 and $180,000. Now, Jake might be slightly ahead here, mostly thanks to using the bank's leverage, but you really have to consider the cost of that slight lead. Jake paid for it with hundreds of hours of unpaid part-time work, taking on a massive debt burden, and concentrating literally all of his risk into a single building in a single zip code. Marcus? He just diversified across thousands of companies and never lost a single night of sleep.
But before we crown a winner, we really have to talk about the hidden traps. Because if we just stop the explainer right here, we'd be doing exactly what those internet influencers do. We have to shine a light on the hidden financial risks that conveniently get glossed over in both of these strategies.
Let's start with the absolute gut punches of real estate. That monthly rent check is the number everyone loves to brag about online, but they conveniently leave out the reality checks, like the fact that the average rental property sits empty for 1 month a year. That is a full mortgage payment you owe with zero income coming in. Then you've got basic maintenance, which generally costs 1 to 2% of the property's overall value every single year. And then there's CapEx, or capital expenditures. Look, roofs generally only last 20 years. HVAC systems, maybe 15. These are guaranteed, undeniable future expenses that are going to hit you in massive $5,000 to $15,000 chunks. Oh, and bad tenants? Just one eviction can easily cost you 3 to 6 months of lost rent, plus attorney fees. That can wipe out an entire year's profit literally overnight.
But hey, it goes both ways. Let's expose the brutal truths of the stock market too, because it is absolutely not all sunshine and compounding graphs. The stock market comes with brutal, stomach-churning volatility. Remember 2008? The market dropped 37%. In March 2020, it dropped 34% in just a single month. Let me tell you, watching your $150,000 portfolio plummet to $95,000 in 3 weeks is absolutely gut-wrenching. Furthermore, there is practically no usable cash flow. A 1.5% dividend yield on a total market fund is definitely not going to pay your grocery bills. You get zero leverage, and you get absolutely no tax magic, like real estate depreciation, to help shelter your income. However, this next part changes everything, all because of one distinct advantage Marcus holds over Jake, and that is scale. Check this out. If Marcus wants to increase his wealth faster, all he has to do is bump up his monthly investment by just $200, and his wealth explodes geometrically through the math of compounding. But if Jake wants to scale his investment, he can't just throw an extra $200 at a house. He has to meticulously save up for a whole new down payment, go buy a completely new property, take on hundreds of thousands of dollars in new debt, and quite literally double his weekend workload. So where does this all end up? That brings us to the 20-year reality check. This is the ultimate milestone. Let's fast forward 2 decades to see what happens when the massive, long-term compounding curves of the stock market finally collide head-on with the massive, deferred capital expenses of real estate.
Prepare yourself for an absolute bombshell. After 2 full decades of completely different strategies, totally different headaches, and wildly different market forces, their net worth ends up in the exact same ballpark. That's right, Jake's equity, after grinding down his mortgage and surviving 20 years of random repairs and tenant turnover, sits somewhere between $400,000 and $500,000. And Marcus's completely passive index fund portfolio, even after riding out some terrifying market crashes, it sits right between $420,000 and $460,000.
So what does this all mean? The fundamental difference here is not the final dollar amount on their balance sheets, it's how they acquired it. Jake literally worked for his money. He essentially bought a second, highly stressful part-time job, absorbed immense operational headaches, and held a ton of concentrated risk. Yes, he built solid wealth, but he paid for it with his time. Marcus, on the other hand, just waited for his money. Sure, he had to endure the psychological torment of insane market volatility, but he retained total liquidity of his assets. And most importantly, he retained 100% of his free time.
Now look, let's be totally fair here. Real estate absolutely can crush the stock market, but really only in very specific, identifiable situations. You need a market with a really strong rent-to-price ratio. You absolutely must treat it as a strict, systematic business, not just a casual weekend side hustle. You can drastically improve your returns by doing something like house hacking, where you live in one unit while renting out the others to completely eliminate your own living expenses. And finally, you really have to utilize 1031 tax exchanges, which lets you roll your profits from one property into a bigger one entirely tax-free. If you master those things, yeah, real estate creates immense wealth.
Which brings us to our final takeaway, the only answer that matters. How do you actually use this information to build real wealth without falling for the influencer hype on either side?
Well, the ultimate mistake Jake and Marcus made wasn't actually the specific asset class they chose. Real estate isn't a bad investment, and neither are index funds. The real trap is picking either one based on a catchy YouTube headline, a 15-second clip, or a random conversation at a neighborhood barbecue, without actually mapping out the true costs in dollars, time, stress, and risk for your own specific life.
So I want to leave you with this one final provocative thought. The next time someone corners you and insists that real estate always wins, or that the stock market is the only logical way to go, I want you to ask them one simple question. Did you include everything? Did you count the hours? Did you count the risks? Did you count the unexpected capital expenses? Because when it comes to your financial future, the answer that includes everything is the only answer that matters.